You may have heard this phrase again recently. The Fed is printing money. Others push back and say, no, that's not happening. And here's the problem. Both sides are talking past each other. Because while the Fed isn't flooding the economy the way it did during the COVID, something is quietly changing behind the scenes. And understanding the differences matters a lot as we move towards 2026. Every time people hear that the Federal Reserve is buying Treasury securities or that the bank reserves are rising, alarms goes off. That reaction makes sense. The last time most people heard about large Fed actions, it came with the stimulus checks, asset bubbles, and inflation. So when headlines start sounding familiar, people assume that the same outcome is coming back. But not all Fed actions do the same thing. And lumping them together creates a confusion. Right now, the Fed is making short-term Treasury bill purchases. These aren't emergency programs. They aren't long-dated bond buying, and they aren't designed to boost consumer spending. They're technical operations. Their purpose is to make sure that the banks have enough reserves and that the short-term funding markets continue to function smoothly. Think of it as keeping the plumbing clear. Not opening the floodgates, this increases liquidity inside the financial system. But that doesn't mean the money is suddenly flowing into household budgets. And this is where the most people lose the plot. This is the part that clears everything up. When the Fed adds liquidity, it doesn't go straight to the households. It flows into the bank first. Then it goes into financial markets. And only later, if conditions allow, does anything reach consumers. That delay matters because liquidity supports stability, not immediate relief. That's why people hear money printing, but don't feel anything change at the grocery stores or the rent or on the utility bills. The money isn't missing. It's just not aimed at the households. The Fed is walking a narrow line. Inflation has cooled, but it hasn't disappeared. The labor market is slowing, but it isn't breaking. At the same time, the economy data has been messy and delayed. So instead of big, dramatic moves, the Fed is making small, quiet adjustments. Lowering rates gradually, easing liquidity carefully, trying to reduce the stress in the system without reigniting inflation is risk management, not a stimulus. This matters because liquidity tends to show up unevenly. First, it stabilizes markets. Then it affects credit conditions. Then it influences investment in behavior. Households come last. That's why 2026 could feel confusing. Some areas of the economy may look healthier. Asset prices may respond. Financial stress may ease, but everyday costs don't suddenly fall just because liquidity improves. Relief doesn't arrive all at once, and sometimes it doesn't arrive at all. So this is not a return pandemic era stimulus. This is not money being dropped into the economy. And it's not a guarantee that the inflation is about to surge again. It's a controlled move, one designed to keep the system functioning while the economy slows into its own. Understanding the distinction matters because expectation shapes decisions. And bad assumptions lead people into the wrong directions. So when you hear someone says, the Fed is printing money again, the better question is, where is that liquidity actually going? Because what's happening right now is about stabilizing the financial system and not fixing household budgets. And the gap between the headlines and reality is exactly what so many people feel stuck. Thank you for watching.